It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know this Friday. The day after a hot inflation print, talks of a jumbo cut fade fast as investors trim rate cut bets. Touchdown in Alaska, Presidents Trump and Putin gear up to discuss the war in Ukraine. And the U.S. government is in talks to take a stake on Intel. We'll have more on that Bloomberg scoop coming up. It was the third consecutive record for this equity market, the 18th of the year. We got there on basically an unchanged market. The S&P was up 0.03% yesterday, despite the hottest PPI print since 2022. You can see we're mostly flat on the major index this morning. NASDAQ, that underperforms, while the Russell tries to claw back some of the major losses it had yesterday. So yeah, it was PPI that seemed to at least move this bond market. We are now pricing in the 90% odds that we get a cut in September. It was over 100 before that. Secretary Besson also speaking on Fox yesterday, trying to kind of walk back or at least define his comments to Bloomberg, saying he's not telling the Fed to cut, just relaying models. So maybe that moving the bond market. But we are rallying, at least on the front end this morning, down by about a basis point. Your 10-year yield stands at 427.90. Let's look at some stocks on the move in the pre-market. With that is Valerie. Hey, Val.
Good morning, Danny. Let's start with Intel. We're seeing shares in the green for a second session in the row. It rose over 7% yesterday and is rising over 2.5% in the U.S. pre-market. This comes after a Bloomberg scoop that the U.S. government is looking at a potential stake in the company, helping it shore up this very massive factory it's building in Ohio. Now, Intel declined to comment on the report, but said that they remain supportive of Trump's economic and technology agenda. Let's stay in technology and move over to Applied Materials. This stock sinking in the pre-market, disappointing earnings. It's really igniting the fears that this trade war is having an impact. They saw soft demand from China and are seeing delays in getting their approvals for those export licenses. Lastly, Warren Buffett is making waves. United Health lifting the entire insurance sector, up 13% in U.S. pre-market as the 13F filings showed that this was the biggest addition to Berkshire Hathaway's portfolio. Danny.
It could certainly use the help these days. Valerie, thank you very much for that. We'll talk to you later in the hour. Also in this hour, in just moments, we'll discuss this equity market and more with Chris Watling of Longview Economics. Later in the hour, we'll look at the week's data that has been with Kevin Gordon of Charles Schwab. Now, stocks are brushing off that hotter than expected PPI to notch another record high. Chris Watling of Longview Economics stays cautious, writing, quote, "The case for summer turbulence in equities remains robust. The U.S. economy is slowing. The Fed is reticent to loosen policy. Earnings expectations are too high, and liquidity in markets is about to tighten." He joins us now, and Chris is chief market strategist and global economist at Longview Economics. Chris, all of those risks, and we continue to melt up. What do you make of the resilience? Is it complacency or is it something else?
Well, I think it's a bit of FOMO, isn't it? People being sucked in as the market keeps moving higher. There was a reticence, I think, amongst institutional buyers and traditional portfolio managers to get involved a couple of months ago. And I think they've been sucked in. You know, you can see that from some of the survey data, the BAML Fund Manager Survey and things like that. So, yeah, I think it's that FOMO effect. But eventually, you know, you run out of FOMO, you run out of road, everyone's all in. And we're sort of getting towards that point. So, yeah, I mean, I think the risks are alive and well, as you articulated.
If that's the case, Chris, and to be clear, it was the risk you laid out, so don't give me credit for that. Credit goes all to you. If there are risks and we're piling and getting FOMO at the same time, does that mean that the downside, when it comes, if it comes, is all that much more painful? And what do you do to prepare for it?
Well, I think the challenge here is really getting a handle on the U.S. economy, because if we are in a proper mid-cycle slowdown, or even there's some rising recession risks, I wouldn't want to overemphasize the recession risk, but I certainly think it's a clear mid-cycle slowdown. And we really need looser monetary policy. So the amount of downside probably almost depends on when the Fed finally gets into the game. And that's what's so interesting about your opening comments. We're going backwards and forwards of 2 cuts, 1 cut, 3 cuts, etc., day by day. And it's quite difficult to gauge, therefore, what we're going to end up with. But I certainly think we need cuts from the Fed, and they need to get on with it. And I think that idea that they should cut 50 or cut 3 times this year is certainly very valid, or 50 in one go or 3 times. So the downside, I wouldn't exaggerate the amount of potential downside because personally, we think it's a mid-cycle slowdown, not a recession. So the Fed can save the day. But often, the market needs to bully the Fed to get on with it. And I suspect that's the case this time. We need a bit of give back in the stock market to get the Fed going, to sort of, get a bit of sort of ants in their pants, as you might say, and get them cutting and get that cutting cycle back underway again.
Chris, there is this argument out there that we won't get that slowdown. And as a matter of fact, you won't get stocks pushing back because AI has become the macro. The vast amounts of capital expenditures that these companies are doing and the growth figures that they're putting in will, one, both keep the economy running something that looks hot and an equity market that continues to have robust earnings, at least for those players that on a headline level supports it. How does that factor into your view?
Well, it's definitely the case. That's the real plus point in the economy. The capex in the hyperscalers and all those thematic AI plays are creating growth. There's no doubt about it. But if you look at the US economy in the round, I think you can see that real income growth in households, real disposable income growth is growing below average levels, about 1.8%. Average is 2.6. That's not good news. Labor market's slowing. Construction's weak. Housing's very weak. I mean, it's a long old list of stuff that is really under pressure. Industrial cycle's not really growing. So can the hyperscalers on their own hold up the economy, and can they hold up the stock market earnings on their own? And I suspect not. And I think they'll probably need a bit of help from elsewhere. And that's why we need the rate cuts. So yes, they've been dominant in the last few months. The Mag 7 and one or two others have been driving the stock market higher since late April. But the reality is, actually, if you look at the Mag 7 as a share of US S&P 500 market cap, it's basically where it's been for the last year. It's been volatile. It's touching its highs it reached in the middle of 24. It made those highs again as a share of US market cap at the start of this year. So I think it's just a bounce back with a little bit of icing on the cake. And, I think we need the market to broaden from here, and we need the Fed to cut rates and support the economy. Otherwise, I think we've got some challenges in that stock market and got that summer turbulence I talked about.
So, Chris, you're describing a scenario where the Fed is cutting for not a good reason, because of an economic weakening. Now, typically, stocks do better in a cutting cycle if it's because of benign inflation. And that's the reason they're cutting. What does that mean about what leadership in this equity market looks like if we're getting cuts because the economy needs it, not because the Fed has the room to do so with easing inflation?
Well, that's a great question, but there's certainly an argument that if we're going to get some softness near term, you actually want to move into defensive areas of the market because they are the cheap areas on a relative basis. They're, US healthcare relative to the rest of the market, relative to other sectors, has almost never been cheaper. Now, you might say there's good reason for that. The new administration changing the rules, changing a lot of the backdrop and in the health sector. But I think a cheap sector that's oversold is attractive, and that's what healthcare is at the moment. So I think that maybe you go short-term defensive before you go cyclical. Once you get those rate cuts, then you start going cyclical. And there are a lot of cyclical areas of the US market that have really underperformed significantly for a number of years. And once we get that rate cutting cycle, I think they'll start to do well. So from a sector perspective, it's been all Mag 7 and growth for a few months. I suspect it'll be defensive for a little bit, and then cyclical is what we're sort of roadmap we're kind of looking at the moment.
Chris, you bring up an interesting point with healthcare, because I believe it's one of maybe two sectors that are lower since the bottom in April, or at least since the start of the year, because of what you're talking about, that political pressure. When you're looking at sectors, we don't have the sectoral tariffs yet, for example. How much are you factoring in politics? How are you sorting when we continue to get headline after headlines, executives called out, new tariffs threatened? What do you decide what is noise and what's investable?
Well, the rule of thumb is, investors become numb to news flow once they get the hang of it. And this sort of news flow in the pharmaceutical sector is not new. We've been having this for several months now. So, I like to look at how oversold the market is or how oversold the sector is. And I like to look at how cheap it is relative to the rest of the market. And as I said, on both metrics, it looks really good in the healthcare sector, which suggests to me that, it's not really new news. It's sort of continuation of the bluster and the tariff headlines on pharmaceutical prices and all the sort of changes of vaccines and healthcare policy and so on. So I think markets getting the hang of it. So I like the fact the sector is very oversold. I think that's very encouraging and very cheap.
Chris, this has been wonderful. Thank you so much for joining us. Please come back again soon. Always good to get your views. Chris Watling of Longview Economics. Let's get you some other stories trending on the terminal this morning. China's economy slowed across the board. Production at factories and mines rose at the slowest rate since November. Retail sales grew at the slowest pace of this year. It's the latest sign that President Trump's trade war is weighing on the world's second largest economy. Elsewhere, Goldman Sachs offering clients a stake in Millennium Management for a minimum commitment of $1 million and as much as $20 million. The documents circulated by the bank indicated an attempt to widen out buyers beyond the typical institutions and towards wealthy individuals. And Warren Buffett's Berkshire Hathaway has a $1.6 billion stake in United Health. A regulatory filing shows that Berkshire bought 5 million shares of the health insurer in the last quarter. The same filing shows the firm sold its entire holding in T-Mobile and trimmed stakes in Apple and Bank of America. Coming up, the first in-person meeting between the presidents of the U.S. and Russia since 2021, happening later today. More on the state of play coming up next on your Bloomberg Brief. Stay with us.
I think it's going to be a good meeting, but the more important meeting will be the second meeting that we're having. We're going to have a meeting with President Putin, President Zelensky, myself, and maybe we'll bring some of the European leaders along, maybe not.
Laying the groundwork for more diplomacy, that's the message from President Trump ahead of his summit in Alaska today with Russian President Vladimir Putin. Let's get straight to Bloomberg's Stephanie Baker for more on this, who also authored the book Punishing Putin. Stephanie, it's great to see you this morning. And look, in a Fox News interview yesterday, Trump said that there were 25% odds that it's unsuccessful, so I guess 75% that it's successful. How is President Trump setting up the expectations for this meeting?
Well, he's definitely downplaying expectations, but it's really clear that Trump does not want to walk out of this saying, I failed to get Putin to agree to, further talks on Ukraine or talks about a ceasefire. He wants this as a win, and he's going to do whatever he can to come out of it with some tangible form of success, whether that be agreement to talk with the Ukrainians about a broader peace agreement or a ceasefire, as well as probably an agreement from Russia to engage in arms control talks and some kind of U.S.-Russia economic cooperation, whether that's in critical minerals or oil north of the Bering Strait, where they're meeting in Alaska. So I think what Trump really wants is to be portrayed as this great peacemaker and that he set this process in motion.
But at the same time that he is downplaying some of the expectations, Stephanie, we've also heard from Trump in recent days basically saying if Putin doesn't agree to certain things, that they will get more tough with Russia. What are the cards that the U.S. has at this moment, and what does it seem is the likelihood that Trump is willing to play them?
Yeah, Trump has not imposed any sanctions on Russia since January, since he came into office. The nature of sanctions is you cannot just let them go. You need to be on it all the time, tracking the kind of companies and tankers that Russia uses to evade sanctions. The Friday deadline has come and gone where Trump said he would impose, sanctions, secondary tariffs on Russia if Putin didn't agree to a ceasefire. And it's pretty sad that they have not imposed anything apart from this planned 25% tariff on India for buying Russian oil, which doesn't come into effect until the end of the month. They can hit Russian oil really hard if they wanted to. They could put full blocking sanctions on Rosneft and on Lukoil, two major oil producers in Russia. They could add another 100 tankers, 150 tankers to the blacklist as part of Russia's shadow fleet. There's a lot of other things they could do. I mean, just the mere threat of the secondary tariffs on India for buying Russian oil, I think, did spur Putin to come to the negotiating table because the fact of the matter is Russia's economy is slowing, and he does not need any additional pressure on his budget. The Russian government relies on Russian oil and gas for about 30% of its revenue, and oil revenues in Russia are coming down in line with the declining global price of oil as the supplies grow. So I think what Putin really wants here is to head off any additional sanctions pressure, and it seems like Trump is playing along with that.
All right, Stephanie, thank you so much for that. That is Bloomberg's Stephanie Baker. And don't miss our live coverage throughout the day of the Trump-Putin summit, which is due to happen around 3 p.m. Eastern. Our Anne-Marie Hordern is out there in Alaska, so stay tuned for that coverage. A quick check on Brent this morning. Prices are falling by about 0.6%, 0.75% for NYMEX crude. Should Trump impose tougher sanctions out of this, you might see some of those moves reverse. Coming up, a Bloomberg exclusive, the Trump administration thinking about taking a stake in Intel. More on that and a look at your front pages this morning. This is Bloomberg. Welcome back to Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at the front pages this morning, the major headlines on the major publications. The Wall Street Journal running with this on their front page, the clashing objectives at the Alaska summit. President Trump hoping to forge a partnership with his Russian counterpart to end the Ukraine war. However, Putin is coming with a very different goal of keeping in Trump's good graces while pursuing his ambition of reasserting Moscow's dominance over Kyiv. Next up on the Washington Post, conflict in the Capitol. D.C. Mayor and Attorney General have rejected orders from the U.S. Attorney General Pam Bondi over the naming of Washington's emergency police commissioner. The D.C. officials called the directive unlawful, arguing that it would not be followed by the city's police force. And finally, a Bloomberg exclusive. The Trump administration is reportedly in talks with Intel to have the U.S. government take a stake in the beleaguered chipmaker. The talks come just a week after President Trump had called for the ouster of Intel chief Lip-Bu Tan. Joining us with the latest is Bloomberg tech anchor Ed Ludlow. Ed, what would be the thinking behind this?
Yeah, I mean, sourcing really clearly indicates that this is about the administration pushing Intel to be focused on the bigger objective of more chip manufacturing in the United States, right? At the heart of this is a future facility in Ohio, which Intel has fallen badly behind on, but had said would be the biggest chip manufacturing facility in the world. And, it's unprecedented to an extent. The American government took a stake in MP Materials in the rare earths theater, which would make the government the single biggest shareholder. We don't know to the extent, from a sort of financing perspective, what this looks like for Intel. But put the money to one side. Intel on paper is everything this administration's been pushing for, to re-onshore an industry that over many decades has left American shores. And it's a great priority for this president.
Ed, would this suggest a trend that might come with other tech companies, too? You have the U.S., for example, taking a golden share after the Nippon Steel deal to acquire U.S. Steel. They bought $400 million in MP Materials, that miner of rare earth minerals, which I believe you mentioned. Is this a model that perhaps it seems like the U.S. is pursuing further?
What was it that Scott Bessent said the other day, that the president is a first principles thinker? This is like highly unusual, right? In my brief career, I've never seen Silicon Valley so aligned with the president on sort of mechanical deals that are different. One thing to note, of course, is that at the same time, this administration put a lot of pressure and moved very quickly to have both Samsung and TSMC accelerate their investment and build out of chip manufacturing capacity in both Texas and Arizona. They want all of it, right? So you have foreign entities involved as well. One thing I'd answer with is that the reason Silicon Valley is excited about this Intel deal, which Bloomberg's reporting, right? Intel has not commented on this and the White House has not confirmed it, is that they feel that actually the best chance America has is that an American company can control the future, because Samsung and TSMC also have to account to their home nations. So when they bring a new generation or technique of manufacturing chips, where are they more likely to launch it? In Korea or Taiwan or in the United States? And that's the debate on why this is a useful exercise with Intel.
Ed, would this also, though, be in tension with what the board of Intel wants, considering there was that Wall Street Journal story about the board and Louboutin being in odds with this disagreement over whether Intel should really be pushing into manufacturing? Wouldn't this be a White House that would be pushing Intel further into manufacturing?
Yes, exactly. I mean, that is the highly analogous story. You know, Intel's also fallen badly behind in different product domains from CPU, and it is way off it on AI accelerator or GPU for data center. But, you know, the origin of lead-edge chip manufacturing is Intel. You know, Santa Clara and the facilities that they had in Oregon and other parts of the United States. That's what the goal of the administration is. More manufacturing capacity from a national security and interest standpoint, but also supply chain continuity, a lesson learned from the pandemic years, and also geopolitical tensions and tariffs with China, right?
All right, Ed, thank you so much for that coverage. We're going to check up with you later in the hour, some earnings to get through as well. That is Bloomberg tech anchor Ed Ludlow on tour in London. All right, this equity market tries to push higher after a third consecutive record high. Coming up, we're going to talk with Kevin Gordon of Charles Schwab on his outlook for the Fed after a hot PPI and a White House that keeps pushing for a rate cut. All of that coming up next on your Bloomberg Brief. It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know this Friday. The day after a hot inflation print, talks of a jumbo cut fade fast as investors trim rate-cutting bets. Touchdown in Alaska, Presidents Trump and Putin gear up to discuss the war in Ukraine. And the U.S. government is in talks to take a stake in Intel. We're going to have more on that Bloomberg scoop coming up for you. The third consecutive record high for the S&P 500, the 18th of the year. It did that basically on what it's doing today. Little change. The NASDAQ 100 underperforms, down by about 0.2. The Russell 2000 had a very bad day after that hotter PPI. By the way, hottest core and headline since 2022. It attempts to claw back losses this morning. All of that, though, meant pressure on the front end of the curve. We're still pricing in something like 90% that we will get cuts come September, but that was over 100% before the data yesterday. Your 10-year yield, that remains unchanged at 428.49. Let's look at some of the stocks moving in the pre-market. With that is Valerie Teitel. Hey, Val.
Good morning, Danny. Let's start with Intel because this stock rose over 7% in the session yesterday. It is rising again, up another 3% in the pre-market. This comes after a Bloomberg scoop that the U.S. government is exploring a stake in the company, wanting to shore up that factory in Ohio that Intel is making. Now, Intel declined to comment on this report, but mentioned that they remain committed to Trump's economic and technology agenda. Let's stay in the chip space and move on to Applied Materials. A bit of a different picture here, Danny. Disappointing earnings, both on revenue and on their guidance. That stock is down near 15% in the pre-market, is really igniting concerns that the trade war between the U.S. and China is going to damage the sector. They had some weak order demand when it came to China and talked about how they've experienced delays with getting export licenses for their products. Finally, let's end with Warren Buffett. He is making waves in the healthcare insurance space. United Health was the biggest portfolio addition in the 13F filings for Berkshire Hathaway. That share is up nearly 13% and lifting the entire health insurance sector this morning. Danny.
Valerie, thank you very much for your work this morning and that roundup. Now to broader markets, where traders are dialing back expectations for a September rate cut following yesterday's inflation data. Kevin Gordon of Charles Schwab weighing in, writing, quote, PPI is just one report, but it takes 50 basis points off the table in September and even takes some steam out of the rate cut argument. I'm pleased to say that Kevin joins us now, senior investment strategist at Charles Schwab. Kevin, great to see you. Thanks for joining this morning.
Nice to see you.
How much was yesterday a game changer, the hotter PPI?
Yeah, I mean, you know, the potential to be a game changer, I think, and when you start to map out some of the impacts from tariffs, not in particular on the goods side, but as we learned yesterday, potentially on the services side too. And I think that it sort of confirmed, you know, some of the heat that you also saw in CPI, because as great as CPI was at the headline level in terms of, you know, either meeting expectations for core or coming in slightly below expectations for headline, there was some heat in some of the services areas that, you know, can't necessarily be ignored. And I think when you think about broadening inflation pressures, of course, through the eyes of the Fed, because that's how we all have to look at this, there is a potential for some of that to be, I think, a little bit concerning. I mean, I think the likelihood for the Fed moving in September, if we get another jobs report similar to like we did for July, it'd probably be pretty hard for them to go against a market pricing of, upwards of 90% for a cut. But it's the from there, I think, that maybe changes, especially if PPI is giving us a little bit of a signal on the services side.
Well, to that point, it was Mary Daly who, before all this data, had basically been saying it's okay if goods runs a little bit hot because services is canceling it out.
Yeah.
So if we don't have that, what does that mean for next week when we get Jackson Hole and any expectations that we get a vibe shift from the Fed, to get a Jerome Powell who, again, said something like last year about this time is the time to adjust?
Well, I think, to some extent, for all the criticism that whether it's the Fed chair or anyone who's a little bit more on the hawkish side lately, I think for all the critique they get, but to some extent, this maybe vindicates it a little bit, where they want to be able to stay in that wait and see mode to see what the impact is for inflation and how long it takes for them to ultimately see price pressures settle, closer to their target. I mean, because you have to keep in mind, through all of this, even with the unemployment rate moving up like it did in July to a cycle high, they're still much further away from their inflation target than they are their labor target. Whether market participants and analysts and strategists want them to focus more on the labor side or not is irrelevant, because they're likely to continue to focus as much on the inflation side as the labor side. But I think that a lot of the language, especially for Jackson Hole next week, to me, I think what's most important is how he characterizes and talks about labor supply. Because that has been, I think, one of the main drivers in thinking, especially, and John Williams, I think, has been sort of at the front of this in making this argument, that because there's almost this race to the bottom for labor demand and labor supply, you probably don't get as much of a pickup in the unemployment rate, even if you create fewer jobs every single month. And if that's going to be the case, where they don't necessarily look at a headline payrolls print that's weak, if it's 50,000 or sub 50, for example, then, of course, the market would probably shift to saying they need to start cutting aggressively, but that's not necessarily how Fed officials view it. So I think that's a really important piece of the puzzle, especially when you look at the context of inflation data we got this week.
Because cutting isn't going to increase the labor supply.
Yeah,
it will
exactly.
do nothing for that.
Right.
What does that mean, though, for what's priced into this equity market? Are the all-time highs we continue to get, is that about hopium for a Fed cut? And if we do get kind of a tempering of those expectations, what does that mean?
Maybe this is a bit of a minority view or a contrarian view, but our view has not been that the market has been rallying in anticipation of a cut. We actually take the opposite view, where the market's been rallying because the Fed hasn't had to cut, because economic data broadly, in the aggregate, have been relatively resilient. You haven't seen a cratering of the economy or the job market. Yes, you took a pretty important, I think, step down and downshift in the first half of the year. Business investment sub 2%, personal spending sub 1%. So there have been notable signs of slowing, but it hasn't been enough to sort of tip you into that traditional recession territory. So because we've been able to muddle through, I think that the market has sort of keyed off of that as opposed to expecting some rate cut. But, that said, we have instances of, in 7 instances throughout history where the Fed has paused for at least 6 months and then they restart a cutting cycle. Historically, on average, which we always say be careful about just analyzing averages, but on average, 12 months after that, the market's done quite well. There's a huge range between those averages, with one of those actually being a recession and a bear market for the S&P. But I think that keeping in mind that, all else equal, it probably adds a little bit, on the accommodative side rather than, tightening policy. That probably helps the market a bit.
By the way, one of the other, I think it's fair to call it kind of contrarian takes you have, is that the market leadership isn't a problem, because people have looked at it like Michael Hartnett of Bank of America and said, oh, we're entering a bubble at the moment. It's all big tech. It's all Mag 7. It seems like you're not as troubled by that.
Yeah, I wouldn't say yet. I mean, if you get to a place where, we continue to make new all-time highs, kind of similar like yesterday. If you have a day like yesterday and that's sort of extrapolated out where breadth is pretty weak, you have a pretty decisive number of decliners in the S&P that are outnumbering the number of advancers, yet the market at the index level continues to creep higher, that would open up a scenario like you had in late 2021 or even late 2024, where you had these negative divergences, where breadth was deteriorating under the surface, but the indexes kept making new all-time highs. We know from history that just is not sustainable for the long term, and eventually the market's weight starts to sort of topple on itself, and that's when you get relatively large drawdowns. I think the important distinction, though, right now is even with a lot of this mega cap leadership lately, number one, it hasn't been equally distributed across a group like the Mag 7 or even the top 10. it's really their contributions in market cap terms that's been more of the standout, not necessarily their performance. So that to us is a really important distinction where for investors who are looking for, whether it's tech or tech adjacent exposure, you don't necessarily need to look just in the mega cap space if it's like the top 10 names or the top 20 names even. The top 10 performers in the S&P this year, none of the Mag 7 doesn't exist in that list. So there have been a lot more opportunities outside of it until you start to see a breakdown, I think, in performance and the number of companies that are actually performing well and that are up. Then I think that it's not necessarily as much of a problem like it has been in the past couple of years.
The past trading session, one of the other things it did is something that seems to also become more normal, not just, maybe bad breath, but the fact that you can have a bond market that was much more volatile, that reacted much more to PPI, and a stock market that just kind of melted up ever so higher. Is there a disconnect between bonds and equities right now?
Not now, actually. What's interesting is in the past month, that correlation between bond yields and stock prices has flipped into positive territory. So all else equal, that means that if bond yields are moving higher, it's for the so-called right reasons or good reasons that economic growth is pretty solid. Inflation is not as much of a concern. If that starts to break in the other direction, that's when you start to get a little bit more, into a worrisome or precarious situation where the bond market is sending a little bit more of a negative signal. But I think that has been one of the supports in the past, few weeks as the market has continued to run higher, is that the bond market hasn't really been much of an issue, a source for concern. So I think that bond volatility staying relatively compressed, FX volatility staying relatively compressed, which has been the case as we moved throughout the summer, that's been very additive for the equity market. You've, just turn the page back almost 6 months, and the dynamic was completely flipped. That, I think, was one of the weaker points or sort of the pillars that was holding the equity market down. Now you've basically flipped that dynamic, and it's been very additive for stocks.
Yeah, it has been a pretty tight trading range. Kevin, this is always a masterclass.
Yeah.
Thank you so much for joining. Great to see you. Kevin Gordon of Charles Schwab. Coming up on the show, markets are bracing for the historic summit between President Trump and Vladimir Putin. That conversation is coming up next. This is Bloomberg.
I think it's going to be a good meeting, but the more important meeting will be the second meeting that we're having. We're going to have a meeting with President Putin, President Zelensky, myself, and maybe we'll bring some of the European leaders along, maybe not.
President Trump sticking to the script ahead of his sit-down with Russia's Vladimir Putin. Let's go straight to Bloomberg government congressional reporter Maeve Sheehy in Washington for more detail. Maeve, thank you for getting up early for us. So what has been the tone heading into this meeting? What are the expectations?
Well, actually, Trump and his team have been really tempering expectations in recent days, trying to say that this is not necessarily the most important meeting, but that the most important meeting will be the second meeting they're going to have, including Ukrainian President Volodymyr Zelensky. So that's pretty interesting here. Trump has been kind of trying to turn expectations down. And then from Putin, you've heard him praising Trump, actually, and saying, that he's a good peacemaker, that he's a good deal maker, which kind of shows that he's trying to maybe butter Trump up a little bit, maybe make him feel better going into the meeting.
What about the mood in Congress? What's the mood there in this first meeting since before the war in Ukraine between the Russian and U.S. presidents?
Yeah, you're not hearing as much on the Hill as you would if it were not August, because they're in recess right now. But you are hearing some things. There's a lot of trepidation from the Democratic side, especially. You saw Senator Jeanne Shaheen, who's a very high-ranking foreign relations Democrat, say that she didn't think that Putin should be invited on American soil, which is very interesting. Other Democrats said that they supported the meeting but did not have high expectations for Trump's deal-making, and we're a little bit concerned about that. Some Republicans are saying that they have better expectations going in, that they think Trump will be able to look tough and also strike the peacemaker key as well. So these are kind of anxious expectations, but on both sides, everyone's hoping it goes well.
They hope it goes well, but Maeve, just given what you're saying in terms of setting a bar low, what is the bar for success? What is the outcome of this that both the Europeans and perhaps the U.S. president would be happy with?
Well, it's hard to say exactly what the bar for success is. Trump said that he thought it would be a successful meeting, but he also said that he thinks it will kind of just be feeling out or table setting for the second meeting that he wants to happen. So I think that what we would see as success here, or what they would see as success here, is probably just keeping relations good enough to have this second meeting. I think that that is kind of what Trump and his team are hoping for, and to avoid any sort of major gaffe or blowout at this press conference after the meeting.
Maeve, we'll see what it brings. Again, our expectation is that it will happen around 3:30 p.m. New York time. Maeve, thank you so much. Maeve Sheehy in Washington, D.C. And don't miss our live coverage throughout the day of that summit, again, around 3:30 Eastern time. Let's now move on to a Bloomberg exclusive where sources say that the Trump administration is in talks with Intel to have the government take a stake in the struggling chip maker. Just 1 week earlier, the president was urging the company's CEO, Lip Bhutan, to step down from his post. Bloomberg tech anchor Ed Ludlow joins us yet again for more on this. Ed, what's the latest?
Yeah, the focus of this administration is getting Intel focused on a future manufacturing facility in Ohio, right? This was an end-of-the-decade type project that Intel had vowed would be the biggest chip manufacturing facility on Earth. But with the change in CEO, throughout the course of the last 6 months, and this kind of worry about capital discipline, they had fallen behind. The opposite of what this administration is trying to do, which is accelerate the growth and re-onshoring of semiconductor manufacturing within the United States.
Elsewhere, Ed, we also had earnings from Applied Materials. Yet again, it's another chip maker really hit by China. What did they say?
Well, Applied Materials is really important barometer of future demand, right? It's America's biggest chip-making equipment name. So if you think about the chip manufacturing process, we've all become so familiar with ASML and extreme ultraviolet lithography. You think about that as the printing of the chip. But you also need to shape and layer the wafer in that process, and Applied Material has a hold in that department. But you always make your orders in advance. So there is softness in China, but Applied Materials has seen a recent upgrade cycle. This isn't equipment you're ordering every year. It's a multi-year process. And so the forecast of $6.7 billion, yes, it is actually significantly below street estimates in terms of the outlook. But there's actually a lot of evidence that actually probably non-China customers are more nervous, and they're more nervous largely because of tariffs.
Ed, when we look through these earnings, Applied Material, other chip makers, how difficult is it to understand the current environment about how much of their sales and orders was something of a pull-through or a pull-forward effect versus steady demand?
Yeah, I mean, so many CEOs have denied to me that there has been any pull-forward effect right across the chip sector. I think behind closed doors that they actually would tell you, particularly within their supply base, they've seen a little bit of it. But it's why I bring up Applied Materials in the context of the full manufacturing process. Look at the other names that are lower in the pre-market, Lam Research being one, just another name as part of the chain. And then ASML was a little weaker in the European session. If you have one key name, Applied Materials, saying we're seeing this certain theme, it's just inevitable that there has to be some ripple effect to others seeing it as well. But again, the difference with chip manufacturing is the build out of capacity or refresh of new technology is a multi-year project. So in the context of tariffs, it's not a pull forward necessarily. It's a let's wait and see what's happened, because I don't want to order a machine that's 50% more expensive if it won't be that way in 3 months' time.
Yeah, very fair point. Ed, thank you so much for joining us this morning. Enjoy the rest of your Friday and your weekend. Bloomberg tech anchor Ed Ludlow, of course, tune in to his tech show later in the morning. Now, Warren Buffett is betting big on United Health. Berkshire Hathaway buying $1.6 billion of shares in the second quarter. Joining us now is Bloomberg Markets Managing Editor Christine Aquino. Christine, great to see you this morning. What do we understand behind the moves from Berkshire Hathaway?
Well, Danny, very interesting move indeed, considering how battered the United Health stock has been over the past year. We know, of course, the idiosyncratic issues that has plagued that company, and they've had a lot of management upheaval over the last 6 months or so. And then, of course, their latest earnings missing for the first time in more than a decade. A lot of turmoil in that company. But perhaps the thinking for Berkshire Hathaway is that the valuation has finally gotten attractive enough, and it has finally declined enough that perhaps there may be a bit of stabilization in the horizon. I mean, Berkshire known very much for investing in blue chip companies that do deliver stable, longer-term returns. And prior to the turmoil of the past year, United Health was one of those stocks. And so perhaps you can see the thinking in Berkshire. Maybe it's now time for that stock to finally peter off the declines and start stabilizing from here on out, because, insurance is generally a safe sector these days.
Christine, it is part of the 13 Fs that we get, and it's sure a little bit delayed and backward looking. But in the second quarter, the other thing that seemed apparent was that hedge funds were adding to tech exposure. What does that tell us about what these firms are doing in what, let's be honest, second quarter was quite a volatile period?
Yeah, absolutely, Danny. I mean, we know that the second quarter was indeed very, very just chaotic for a lot of market investors, right? I mean, we saw the Liberation Day tariffs being unveiled during that period and then a few days later pulled back. But, the move toward tech stocks really just testifies to the fact that big tech in times of turmoil is still very much seen as a safe haven. I mean, it makes sense that hedge funds would want to flock to companies that are probably likely to be more insulated from all the volatility, have a lot of cash flow built up in their coffers, and can weather such a storm. And, the preference for tech over, say, smaller stocks or companies that are more focused on the domestic economic situation in the U.S. during that period of such volatility makes a lot of sense. And, of course, we've seen the rebound since then. They've been handsomely rewarded for those positions.
Christine, thank you very much for breaking down those filings for us of the hedge funds. Christine Aquino. Now let's get you some other top stories that are trending on the terminal this morning. China's economy slowed across the board. Production at factories and mines rose at the slowest rate since November. Retail sales grew at the slowest pace this year. It's the latest sign that President Trump's trade war is weighing on the world's second largest economy. Elsewhere, Goldman Sachs offering clients a stake in Millennium Management for a minimum commitment of $1 million and as much as $20 million. The documents circulated by the bank indicate an attempt to widen out buyers in Millennium beyond institutions and towards wealthy individuals. And Masayoshi Son added $11 billion to his fortune in just the first 2 weeks of August. SoftBank's AI bets sent its shares to a record high. Son's net worth is now at $33.3 billion. That makes him the second richest person in Japan. Coming up, counting down to the historic summit in Alaska, we've got the market-moving events that you need to watch out for in your trading diary coming up next. Welcome back to Bloomberg Brief. Danny Berger here in New York. Let's get you set up for your trading day on this Friday. First, we're going to get retail sales data. That comes at 8:30 a.m. Eastern. It will be followed by more data, the University of Michigan Sentiment Survey published at 10 a.m. And finally, the main event comes this afternoon with President Trump meeting with Vladimir Putin in Alaska. That's set to happen around 3:30 p.m. Eastern. Some individual stocks on the move pre-market. Intel, those shares up more than 3%. A Bloomberg scoop about how the U.S. government is in talks to take a stake in the chip maker. It jumped when originally that story came out. Applied Mats, though, that share's down 14.5%. It warned of a drop in revenue in the current quarter on a slowdown in demand from customers in China. Finally, United Health, all of that over the Oracle of Omaha. Berkshire Hathaway reporting a $1.6 billion stake in the health insurer. So those shares up just over 12.5%. Elsewhere, it is all calm in markets. I got to say, it was really calm in equities yesterday, even though we had PPI that came in the hottest since 2022. We pared back some of the rate cut bets, still around 90%. Scott Bessent also talking about his call for lower rates has to do with just talking about models, not telling the Fed to cut. So even so, you have your 10-year yield, little change this morning at 428.87. The equity market, again, little change after a third consecutive record, 18th of the year. Can we do it again? All right, that is it for Bloomberg Brief. Surveillance up ahead. You're watching Bloomberg TV.